This is Mark to Market, a podcast of BT correspondents.
Hello everybody, welcome to Mark to Market, a BT correspondence podcast that aims to provide analysis and insight on market trends and corporate issues in Singapore. My name is benpaul and I'm a senior correspondent at the Business Times. Every week, my colleagues and I delve into a business story that matters. We're in the month of November 2024, and one unfolding corporate deal that has been making headlines in recent weeks is the offer for Dyna-Mac Holdings. Now, this offer was scheduled to close within a few days of this podcast recording, so the deal might have already been concluded. But this is an offer that I think is going to be talked about for a while, regardless of the outcome, because some aspects of it, in particular, the work of the Independent Financial Advisor, or IFA, are rather interesting. Let me start off by saying this is not another lowball offer from the controlling shareholder of an underperforming company with a depressed share price. On the contrary, Dyna-Mac is one of a number of offshore and marine engineering companies in Singapore that is experiencing a big revival in its business. Its main activity is fabricating topside modules for floating production, storage and offloading vessels, or FPSO vessels as they're commonly called. For the first 6 months of 2024, Dyna-Mac reported a 42.5% increase in revenue to $259.7 million. Its earnings jumped nearly 300% to $38.8 million. The company attributed these strong numbers to the completion of major projects and improved productivity. Dyna-Mac said its order book stood at $681.3 million as at the end of June, with deliveries scheduled all the way to 2026. It also said the global FPSO market is expected to grow 14.6% per annum to $34.7 billion by 2032. Dyna-Mac has also recently expanded its capacity and upgraded its yard facilities. This will enable it to take on larger projects and boost its productivity. On top of that, Dyna-Mac is in good financial shape to expand its business, both organically and through acquisitions and strategic alliances. At the end of June, it was in a net cash position of $307.7 million, including its holdings of Singapore Treasury bills. That's not bad for a company with a market cap of about $830 million. Reflecting the strong operational and financial performance, shares in Dyna-Mac have been on a tear. Since the beginning of the year, up until the day before the offer was announced in September, its shares had climbed nearly 48%. So, who would be interested in acquiring Dyna-Mac against such a bullish backdrop? The offer for Dyna-Mac came from a special purpose vehicle controlled by Hanwha Ocean and Hanwha Aerospace, both of which are listed in South Korea. Through the special purpose vehicle, they initially offered to pay 60 cents per share for Dyna-Mac, but subsequently raised the offer price to 67 cents per share. The offer is conditional upon the offerer ending up with more than 50% of Dyna-Mac shares, and the Competition and Consumer Commission of Singapore deciding that the deal will not lessen competition in any market in Singapore. Now, Hanwha Ocean and Hanwha Aerospace are not the controlling shareholders of Dyna-Mac. When they announced the offer in September, they held 282.9 million Dyna-Mac shares, which was equivalent to about a 24% stake in the company. Most of their Dyna-Mac shares had been purchased from Keppel only in May for 40 cents each. So, on the face of it, the Hanwha Group appears to be quite determined to add Dyna-Mac to its stable of companies. The offer document stated that Hanwha Ocean builds a wide range of vessels critical to the offshore and marine sector, and that it's implementing a multi-yard strategy across strategic locations, including in Singapore, South Korea, the United States, and China. Hanwha Ocean and the offerer plan to help Dyna-Mac strengthen its competitive position and make the most of opportunities related to the global energy transition trend. Now, the offerer initially encountered some resistance. When the deal was first unveiled, Dyna-Mac shares immediately climbed above the offer price. And the estate of Desmond Lim, the late founder of Dyna-Mac, said the offer was not compelling. Lim's estate, which holds more than 35% of Dyna-Mac, pointed out that the company's shares had traded above the initial offer price not that long ago, and that some analysts had price targets for the stock of more than 70 cents. So, because of this resistance from the market, the offerer raised its offer price from 60 cents to 67 cents. Dyna-Mac shares are now trading slightly below the revised offer price, which is enabling the offerer to acquire some shares in the market. So the offer at the final price of 67 cents per share might just work, but we'll have to see. This brings me to the really interesting thing about this whole deal. The offerer specifically stated at the outset that it does not plan to actively pursue a delisting of Dyna-Mac. That doesn't mean it would not delist Dyna-Mac if the opportunity arose. In the event the free float requirement is not satisfied at the close of the offer and trading in Dyna-Mac is suspended, the offerer has said it does not intend to take any action to remedy the situation. The offerer has also said that it will exercise its compulsory acquisition rights if the level of acceptances allows it to do so. Now, I did not initially think the offerer not planning to pursue a delisting of Dyna-Mac really mattered. However, when the IFA's letter on the deal came out a couple of weeks ago, I realized that it actually does matter. One aspect of an IFA's evaluation of these sorts of offers is a comparison against precedent transactions. And because the Hanwha Group is not looking to take Dyna-Mac private, the IFA compared its offer against precedent non-privatisation transactions, where most of the deals are mandatory general offers rather than voluntary general offers. Major shareholders of companies are sometimes required to make general offers for technical reasons rather than because they necessarily want to acquire the whole company. In these instances, the offer price can be quite low. In some cases, it's well below the market price of the target company's shares. Is Dyna-Mac's IFA right to compare the offer from Hanwha to these transactions? Does it really matter to minority shareholders of Dyna-Mac? I'm going to talk about that next.
If you've been a fan of the podcast Mark to Market, Wealth BT and Property BT, they are moving to a new listing, BT Correspondence. Look for episodes every Tuesday from October. All the insights and analysis in market trends, property, wealth, and soon mobility too. Powered by the Business Times journalism of Genevieve Kwa, Leslie Yee, benpaul, and Darren Wong. Because great reads should be heard. The BT Correspondence channel. Find BT Correspondence wherever you listen to podcasts.
And now, back to Market, a podcast of BT Correspondence.
Independent financial advisors, or IFAs, are an important part of the local market ecosystem. For instance, SGX requires that companies seeking to delist come up with an exit offer and appoint an IFA to consider if the exit offer is fair and reasonable. Companies are also required to appoint an IFA to determine if their interested party transactions are on normal commercial terms and not prejudicial to minority investors. But Singapore's market regulators do not prescribe exactly how IFAs should go about doing their work. Instead, a lot of emphasis is placed on IFAs being independent and unburdened by conflicts of interest, and that they are diligent, objective, and transparent in their analyses and opinions. Now, I wanted to just put that out there before commenting on how Dyna-Mac's IFA, a firm called Zico Capital, evaluated the offer for the company and came to the conclusion that it was both fair and reasonable. I'm not suggesting they did not do the job properly, I'm just offering a different view on some aspects of their analysis. First, as I mentioned earlier, the IFA compared the offer to precedent non-privatisation offers since 2020. All but one of those offers were mandatory general offers rather than voluntary general offers. They included deals such as Temasek's mandatory general offer in September 2021 for Sembcorp Marine in the wake of the company's rights issue at a deeply discounted price of 8 cents per share. At that point, Temasek held a nearly 43% stake in Sembcorp Marine, or Cetrium as it's now called, and Temasek had provided an undertaking to mop up a portion of the excess rights shares. This resulted in its shareholding in Sembcorp Marine expanding to nearly 47%, which triggered the mandatory general offer. Another precedent non-privatisation deal was the offer for Lianbing Group at 50 cents per share back in June 2021. Again, this was a mandatory general offer triggered by the company's controlling shareholder, which held about 44% of the company at the time, increasing its stake by more than 1%, in this case after buying some shares through a merit deal. The offer said it intended to keep Lianbing listed and that it would not be able to exercise any rights of compulsory acquisition. It's worth noting that Lianbing actually went private last year following a separate offer at 68 cents per share. Now, the precedent non-privatisation deals to which the offer for Dyna-Mac were compared were quite flattering. The offer prices in these deals were on average 6.3% below the target company's volume-weighted average prices over the preceding 1 and 3 months. So, by and large, these deals were not about the offerers paying up to increase their stakes in the target companies. By comparison, the offer price for Dyna-Mac was 18.6% above its 1-month volume-weighted average market price and 27.4% above its 3-month volume-weighted average market price. This more favorable premium versus the precedent non-privatisation deals was among the factors the IFA cited as supporting the fairness of the offer. This seems rather strange to me. In my view, the offer for Dyna-Mac should not have been compared to these non-privatisation transactions. The offer from Hanwha is a voluntary general offer, and the offer's intention is clearly to increase its stake in Dyna-Mac. Moreover, even though the offerer is not bent on acquiring every single share it doesn't already own, it has not ruled out going all the way and taking Dyna-Mac private if the opportunity arises. Another factor that the IFA cited in support of the fairness of the deal is that the final offer price is nearly 6 times Dyna-Mac's adjusted net asset value. This is way above the price to NAV of comparable companies such as Citrium, Malaysia Marine and Heavy Engineering, Jutal Offshore Oil Services, which is listed in Hong Kong, and Rossetti Marino, which is listed in Italy. These comparable companies are trading at a mean price to NAV ratio of 1.26 times, according to the IFA's letter. But here's the thing. Dyna-Mac has a trailing 12-month return on equity of 55.8%. This is way above the comparable company's mean ROE of 11.2%. In fact, Dyna-Mac's return on assets and net profit margin are also vastly better than the comparable companies. The way I see it, the relatively high price to adjusted NAV implied by the offer price for Dyna-Mac is more than justified. I'm not sure it ought to have been cited as a factor supporting the fairness of the offer without also considering the company's very strong profitability. To be clear, I'm not challenging the IFA's conclusion that the offer is fair and reasonable. Dyna-Mac operates in a very cyclical and competitive industry, and I would be wary of suggesting that its currently strong profitability will be sustained indefinitely. In any case, shareholders of Dyna-Mac do not have to follow the recommendation of the IFA and accept the offer. If they disagree, they can simply hold on to their shares. The converse is also true. In the case of Lianbing, even though the IFA it appointed said the offer last year was neither fair nor reasonable, the level of acceptances was so high that the offerer was able to take the company private via the compulsory acquisition route. However, I do think it's important that investors as well as corporate boards scrutinize the work of IFAs and push them to justify their views and recommendations. Singapore is home to lots of very interesting companies, in my view. As interest rates around the world gradually ease and global capital increasingly flows to this region, reviving economic activity and asset prices, there could well be many more voluntary general offers, not because the target companies are eye-wateringly cheap, but because, like Dyna-Mac, they hold a promise of better prospects and growth. That's it for this edition of Mark to Market. BT Correspondents will be back next week with wealth editor Genevieve Kwa, so please keep listening. In case you haven't heard, Mark to Market is now part of the BT Correspondents channel. That's where we'll be posting our new episodes from now on. Go follow BT Correspondents so you don't miss out. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm benpaul. As always, thank you for listening and join us again next week.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.